From New York City for our viewers worldwide, I'm Sonali Basak, and Bloomberg Real Yield starts right now. Coming up, yields go for a ride. A sharp leg higher on Thursday cedes some ground to end the week. And Fed speak, it's mixed, with officials saying that the market is tightening rapidly. And inflation still running hot. But how hot is too hot for the Fed to push rates higher? We begin now with the big issue. The market gets ahead of the Fed.
The bond market is tightening financial conditions, and that is doing the work for the Fed.
The rise in the long end yields, if anything, was doing the Fed's job.
We think that the Fed is done hiking. I mean, we've been watching these rise in bond yields over the last few weeks and tighter financial conditions. And so we think that that is doing some of the work for the Fed.
The Fed is probably done raising interest rates because they realize that the bond market's been recently doing all the heavy lifting.
Don't worry, the Fed would have to do less because the market's going to do more. It doesn't quite work that easily.
Now, we're coming off a week with drastic moves in the bond market. The 10-year alone, intraday, whipsawing over the last 3 days, 20 basis points or more. So what does that mean for the direction of travel here? Because we have seen kind of an orderly rise forward in yields, rise upward. But if you look in recent weeks, we've really tested those highs. In fact, have surpassed those highs fairly recently. Now, the move lower in yields today supports the trend. But if we were to see a leg higher, then all of a sudden you have a new trend beginning. I want to lift up the board here just to show how painful this move higher has been for investors. Because people pouring money into the bond market, thinking that these yields were appropriate, have lost a lot of money. The last 3 years alone have been negative for bond investors, and this again is the 10-year alone. We are coming off the worst year since 1999 for investors last year. That trend is continuing now very meaningfully into the end of this year. Now, joining us for more is Barry Knapp of Ironsides Macroeconomics and Brian Smedley of the Cynosure Group. Barry, you know, when we start to think about what we've seen just this week alone and what we've heard from Fed officials in terms of the idea that the market is doing the work for the Fed, do you believe them?
Well, I would frame it differently. There's three ways to disinvert the curve, and make no mistake, the curve needs to be disinverted by 2024 for the banking system to absorb all the multifamily real estate projects that need to be rolled, the supply of credit to small businesses to flow in 2024. So of those three ways that we could disinvert the curve, we were on the benign path, which was a potential bull steepening where the Fed cuts rates because inflation is coming down, not because employment weakens. But what began at the beginning of August was the most insidious way for the curve to disinvert, which is a bear steepening, long rates rising potentially through 5% on 10s and 30s, which would leave a lot of carnage in its wake. Bank portfolios, securities portfolios for one. And that move was well underway in August. We thought that the Fed understood the risks of exacerbating that move, but they made what I would consider their third communication blunder through the course of the tightening cycle. The first coming in September of 22, the second coming at the monetary policy report in early March of this year, which was quickly followed by bank collapses. And then again this time. So the Fed actually exacerbated this move. The market didn't do the Fed's work. The Fed exacerbated a supply-demand imbalance that existed in the Treasury because of unsustainable debt finances. And so I don't really think, I just would frame it as the Fed made a blunder here, which they tried to partially reverse this week.
Now, I want to point to another view in the market here, because former Federal Reserve Bank of St. Louis President James Bullard in Morocco on the sidelines of the annual meetings at the IMF and World Bank said the risk that's underpriced in markets is that disinflation stalls out or stops altogether and core PCE inflation starts to go up again. And if that starts to happen, the committee will have to contemplate going to 6% or 6.5%. What's that risk, Brian?
Yeah, I actually think that's an important risk for us to bear in mind. And I think I would differ a little bit in the interpretation of the bond yield move over the last few months. I think it's partly due to the fact that oil prices have come off weak levels mid-year. We've been choppy this week, up about $5 a barrel on WTI, but on balance, oil prices have moved higher. And in a world where the Fed needs to bring inflation back to target, any move upward in commodity prices that could pass through to inflation and inflation expectations needs to be met with higher real yields. And I think that's part of the story. Also, real GDP growth has surprised to the upside for the last couple of quarters. You know, this talk that the markets are doing the Fed's work for it is reminiscent of what we heard in March when we had tightening in bank credit conditions or expectation in the turmoil of banks around Silicon Valley Bank failure. Well, if you look at real GDP growth in the 6 months that's passed, we've completed about 4% real GDP growth and very strong payroll growth in that period.
Now, if you look at this idea of the Treasury market as a haven bid, do you think that starts to complicate this idea that yields could go higher, Brian?
Well, I think so. And obviously, the situation in Israel, in the Middle East, is very tenuous. You know, let me just say that our deepest sympathies are with the people of Israel, of course, after this terrorist attack. And now millions of lives are disrupted with the war. But there is a significant risk of a disruption in oil supplies that could meaningfully impact the trajectory of the economy and monetary policy.
Now, it's interesting. You have Jim Bianco of Bianco Research Online also pointing out this idea that the sharp moves in the 30-year only happen when something's up. What is up, Barry? Do you think that these moves will continue to be exacerbated either because of macroeconomic reasons or because of Treasury market liquidity concerns?
Well, it's the supply-demand imbalance. I only really recall, and I've been at this 39 years now, two serious events where excess supply really caused a backup in long-term rates to absorb that supply. The first began on January 4th, 2021, when the Republicans lost the Senate. We went from expecting no new stimulus to an additional $1.9 trillion. If you take the 30-year real rate or TIPS yield, which is the part of the curve least impacted by the Fed's balance sheet or rate policy, that backed up some 60 basis points. The same magnitude of move occurred after the Treasury announcement that they were going to sell $500 billion more in the second half of this year than was expected. So to me, that was clearly driven by supply. And as I said, I think Fed policy exacerbated that imbalance. Now, the fact that they've backed away from another rate hike in November is a partial pivot that does provide some cushion against instability in the back end of the market, but it really does come down to supply. And I actually spoke at an event with Jim recently, and you know, I'm in broad agreement with him that, you know, things have changed a bit around the supply and demand dynamics for the Treasury market.
Speaking of supply, what about demand, Brian? When you look at what happened with the auction just yesterday, there was a lot of concerns about the dealers having to step up the way they did. How does that bode as more supply continues to hit the market?
Well, it's a challenge for the market to digest a great deal of bond supply. And Barry hit on the fact that those estimates from the Treasury have increased. And, you know, sometimes we could look at that and say, well, that's an exogenous shock to, you know, supply-demand dynamics in the bond market pushing up term premiums. But there's also an economic impact. The reason that bond supply from the Treasury is increasing to such a degree is because we have an enormous fiscal deficit. That fiscal deficit, the dissaving of the public sector, is being transferred into a positive balance of saving in the private sector and is furthering the excess demand story in the real economy. We've seen strong consumer spending, strong business outlooks. And so as we hear, you know, quarterly earnings coming up, so far starting with JP Morgan, a pretty rosy outlook.
Speaking of JP Morgan, you had JP Morgan CEO Jamie Dimon bringing up the issue of quantitative tightening once again. He has repeatedly raised this risk. When you think about this, Barry, how much tighter can that create financial conditions in the wake of the balance sheet of the Fed stripping out some of that liquidity?
Well, there's a couple of issues that come to mind off of the things that Jamie said. First is quantitative tightening will eventually run into a problem in terms of total bank reserves. Now, those have been relatively stable around $3.1, $3.2 trillion or so. It's estimated by some, including my former colleague Joe Abate over at Barclays, that around $2.7 trillion in the bank liquidity is going to start to tighten, and the Fed may find themselves in a position of having to at least restructure QT, maybe take the reinvestment of mortgage paydowns and put them in Treasury bills to keep that abundant reserves environment in place. But the other thing Jamie got at, which is a much bigger issue for the banking system and for broader credit creation, is the excess capital that's being pushed by the administration and Vice Chair for Supervision, Barr. I would know, I did a lot of work at this back when I was Barclays equity strategist. In the 50s and in the 2010s, the 14 to 18 period in particular, bank ROE never got above 10%. In that environment, credit creation tends to be fairly tepid. That bleeds over into broader capital formation and overall aggregate growth. And so Jamie's not just talking about his share price. He's talking about aggregate economic activity from too much credit in the system. And lost in Michelle Bowman's speech earlier this week in Marrakesh was a pushback on that. So you actually have a little battle underway within the FOMC where Bowman doesn't want to increase those capital requirements and Barr does. So I think Jamie's really onto something, because it'll make bank stocks really uninvestable if these proposals go through. They'll perform like they did through most of the 2000s when, as Barclays equity strategist, I was underweight them, but it'll also bleed over into growth and credit, the supply of credit. So
now, Brian, to the last thought here, the big question mark in the market is the yield curve. How are you reading some of these moves at the long end relative to the short end?
Yeah, I think the interesting move we've had in the last week has been a flattening of the curve, notwithstanding yesterday's week 30-year auction. Long bond has led the rally in yields this week. But over the course of the last several months, the story has been, a bear steepening in the yield curve. And I think Barry talked a little bit about the expectation that the Fed's not going to hike in November 1st. That potentially tees up an interesting decision in December. I think that will largely be dependent on how financial conditions evolve between November and mid-December. But I think what we'll be watching at Cynosure is whether, in a typical scenario where the Fed is on pause for an extended period of time, the 5s/30s curve usually bull steepens, where there's a rally in the belly of the curve as the market prices in the next easing cycle, and the long end of the curve declines but lags the move. And I think it'll be interesting this time to see if we see a bear steepening where yields move higher, led by the long end, which has been the trend of late.
So market long in search for good news. Brian, thank you so much for your time. That is Brian Smedley of the Cynosure Group and Barry Knapp of Ironsides Research. Thank you very much for your time. Now up next, the auction block. A sweet deal arrives amid all the stress over rising yields. This is Real Yields on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the auction block, where I want to touch on rates once again. I mentioned that high-profile 30-year auction, it was awarded at the highest yield since 2007. The primary dealer award was also the highest in more than a year. Looking at U.S. investment grades, J.M. Smucker tapped the market to help finance its acquisition of Hostess Brands. The week on the whole had over $13 billion in sales. And cruising over to high yield, a unit of Norwegian Cruise Line sold nearly $800 million to refinance debt. The whole market priced about $2 billion this week. And on credit, PGIM's Greg Peters this week warning that borrowing is only going to get more expensive from here.
The cheaper credit has rolled off. That's going to be replaced with more expensive terms. And so if you think about how many companies, have really kind of utilized this zero and negative rate environment to their benefit, that really starts to go away. So I think credit, it really matters where you are in credit. And the more levered you are, the more susceptible you are.
And joining us now is Winnie Cisar of Creditsights and Colleen Cunniffe of Vanguard. Winnie, let's start with you here, because when we look at the caution that's seeping into the markets, things have held up pretty steady until now. At what point do bond investors get more materially worried about losses in riskier parts of the market?
So that's a great question, because we have seen credit spreads hang in much better than we would have anticipated. And we actually recommended that our clients take a little bit of a short-term cautious stance. We have that on really through the Fed meeting on November 1st. That also coincides with the Treasury refunding announcement, and will probably be when we start to hear more on the U.S. budget and potential government shutdown front as well. So I do think that in the near term, we could see some pressure on spreads as we have seen so much rates and now equity market volatility. And the reality of these higher borrowing costs are starting to become much more front and center as people look ahead to 2024.
Colleen, if you think about how markets have been behaving, the intense volatility in the safest markets in the world, when does that start to roll over and impact high yield and even investment grade markets?
Yeah, thanks for having me. You know, on the high yield side, obviously, and on the investment grade side, volatility is a concern. None of the markets like volatility, and you know, the markets have held in pretty well so far. What we're continuing to look for as we kind of go out is signs of weakness that we think could flow through to the economics and fundamentals of the companies. As we've discussed in prior shows, you know, we're heading into this environment with pretty strong balance sheets. But, you know, chatter about the consumer that has been very strong and driving performance, potentially starting to feel some weakness, you know, could flow through into the numbers. So we're going to continue to look for that. And at that point, you know, if you have that and the volatility combined, you know, then you could see more impact on the markets.
Now, Colleen, what does this mean for new issuance? You are starting to see a market that is starting to come back. You are starting to see the core of Wall Street get excited about this idea of new issues. But do you think that some of this volatility can throw things off course and set off investor demand for new deals?
Well, look, on the high yield side, you know, what we've seen so far in the last, say, month or so, deals coming to market. The market is receptive. Deals are getting done for companies that the market is well familiar with. Trading has been a kind of flat to sideways. So I think we're going to continue to kind of see that environment as we go through towards the end of the year. So markets are by no means closed, but I think people are selective. Like I said, you know, everybody's just trying to find those points where we might start to see some weakness that could flow through.
Now, Winnie, if you think about the types of credit risk that are available in the market today, do you think that it is more prudent at this point to take on credit risk or duration risk?
So we have been more thoroughly embracing adding duration risk to portfolios. We've been recommending a barbell strategy for much of the year, telling investors that they should be starting to extend duration so long as long-on yields are above 4%. And we're well above that at this point. Credit risk has outperformed quite magnificently this year and even last year as well, even though we did see some concerns around recession and defaults rising. And at this point, we do think that the duration play feels like a more attractive play on a long-term basis over the course of 2024.
Now, if you think, Winnie, about the entry point, at what point are you getting rewarded for taking on credit risk?
So I do actually like still a lot of the high yield market. I think that you have to navigate triple Cs pretty carefully, as valuations there are not particularly cheap, especially in the US market. Perhaps in the Euro markets, it's a little bit different. But double Bs, especially relative to triple B valuations, actually look pretty attractive on a duration-adjusted yield basis. And we note that a lot of double B capital structures are in very solid shape with fundamental metrics that are pretty much in line with or approaching investment grade levels. And then the single B universe, we have seen a number of issuers demonstrate that there's still investor appetite for new deals and the ability to refinance. And that leaves us pretty constructive on kind of the 3 to 5 year segment of those single B capital structures.
Now, Colleen, if you think about the point you made a little earlier, this idea that you have not yet seen a lot of pain, this idea here that the maturity walls are still coming up in high yields, bankruptcies are ticking higher, yet you're still not hitting levels that were reminding you of prior economic downturns. How much are investors really willing to take on risk, knowing that the worst of the bankruptcy cycle is perhaps not over and that these maturity rollovers will mean higher interest rates?
Yeah, I think I'm going to bifurcate my answer into the two markets that we focus on the leverage side, you know, high yield versus leverage loans. You know, the high yield market is just of better average quality than it has been through prior cycles. The default rates are continuing to remain pretty reasonable, and even when you look at the distressed rate and figure those turning into defaults, we still think it is pretty manageable. Even on the interest coverage, if you look through the metrics, over 4 times basically across the market is a much better position than, say, with the last crisis, right? So I think on the high yield side, again, we're a deep credit research shop, so we're always going to say you have to do your work and pick your spots and understand your companies. But I think we're pretty comfortable with the risks that we see on the high yield side. The leveraged loan market, that is a place where we think that more defaults will occur, and the credit fundamentals, particularly on the lower end of the leveraged loan market, meaning the smaller end of the leveraged loan market, continues to be a space where we think is relatively risky. Again, we pick our spots, but that's how we view those two markets at the moment.
That's Winnie Cisar of Creditsights and Colleen Cunniffe of Vanguard. Thank you both for your time. Now, still ahead, the final spread, the week ahead. Earnings season, plus ramping up a host of Fed speak. This is Real Yields on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up Monday, Philadelphia Fed President Patrick Harker is kicking off all of the Fed speak. We'll talk more about that in a second. Tuesday, Bank of America and Goldman Sachs reporting earnings, followed by U.S. retail sales. And on Wednesday, Morgan Stanley reports to round out the big banks before tech earnings begin. And then we have all of that Fed speak ahead of us, starting with Patrick Harker, Philadelphia Fed President. You also have Bostic, Logan, and Powell. Jerome Powell ending the week on Thursday, really the big moment of the week, speaking at the Economic Club of New York with our own David Weston. We'll also hear from many others throughout the week, from New York to London, including New York Fed President John Williams speaking at Queen's College in London, and Fed Governor Christopher Waller also speaking in London. That would be the same day on Wednesday as the Fed releases its beige book on Wednesday. And that's on top of all the bank earnings and economic news that we will get for a very, very busy week for rates, coming off an already very volatile week for interest rates. From New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.